This is Rich Morrison, and welcome to my latest edition of the Thinking Cap. Today, we're going to have one big, beautiful look at the charts. Look and see where things are at right now. We've got several markets that are up and running. We've got several markets that are just plain flat right now, and we're waiting for something to make a move. And so, let's dig in and look at the ag markets. And right now, the hottest market that we have is the hog market. If you look at the heat check column every day in the market report, hogs are at the top right now. You've got new highs in the August hogs. I think you got to go back to 2023, the last time we've traded to levels in this area. You see the RSI at about 72 this morning, stochastics up at 90. Now, that said, the market's just a little bit weaker here at the start of the day session. I'm recording this on Wednesday morning. You can see RSI stochastics maybe starting to turn a little bit. So wouldn't be a shock to see a little bit of a top in this market. And, for folks that use LRP insurance, for the hog folks, this would be a prime time to be looking at utilizing some sort of a policy to basically put a put option under the market right now. Looking at the cattle market, August live cattle continue to really follow these 9 and the 20-day moving averages. That's been buoying this market for several days. I would suggest that, we're not overbought like we are in the hog market. RSI is at 58, stochastics are in the 50. So I'm not afraid to follow this market up a little bit, but kind of keep this in mind. If you're following the market, if we were to break below the 9 and the 20-day MA lines, not a bad time then to put on some risk protection if the market breaks. And same with feeder cattle. You look at the August feeders, the 9 and the 20-day continue to be pretty good support. We're still a few dollars away from the high from back in May. So you can ride this a little bit, but keep in mind, watch this support. If we were to break below the 9-day moving average, not a bad time to be putting on some risk protection. Flipping to the crop markets, the hottest market we've had of late is the Minneapolis September wheat chart. And it's really been driven by the initial crop ratings that we had out a week ago. You can see that last week the market really spiked following those crop ratings numbers. A, we don't have as many acres this year, and B, the I guess perceived slower start to the year gave us a boost, and now we've given some of that back the last couple of days. But and you can look. One of the things I had mentioned last week is this 200-day moving average. We just haven't been able to spend a lot of time above that, and really gives you the bigger picture that the wheat. It's hard to get a bull picture in wheat. So when we trade above the 200-day moving average, probably a good time to be hedging. Unless we see some big major change in the big picture. Lately, the Ukraine-Russian war, it's kind of been back and forth. You go back 2 or 3 weeks, it looked like things were going to get settled or some sort of a settlement. Lately, that's not been the case, and I think that's also given a little bit of a lift to the wheat market. But I want to sell the rallies, of course. That was a 60-cent rally off the low, not a bad place to be selling. If we get back down around the, down in the $6 area, probably look to buy it back if you're trading in and out of hedges. We still haven't gotten back to the insurance price at 655, which is always one of my targets. Haven't been able to get to that level, but still, I do think if you get back up above, back to this recent high, not a bad place to be making a sale. Looking at Kansas City wheat, Chicago wheat, just pretty ho-hum right now. Markets traded sideways over the last couple of weeks. You see the RSI virtually at 50, stochastics in the 60s. So, we are off the lows, 30-some cents, but again, you look at the 20, the 9, the 50-day moving average, we're just kind of flat right in that range. I would still suggest, a run back up to the 100 or the 200-day moving averages up in the 570s, 580s would be a good sell, especially with harvest coming on here very, very soon. So take a look at that. Chicago wheat, very similar chart. We're stuck in this range of these short-term moving average lines. If we're to get back up to the 100, the 200-day moving average, probably not the worst place in the world to be making a sale. So up into the 560s, 570s here in Chicago wheat. December cotton. it just can't quite get anything going either. You can see the 200-day moving average has just been a ceiling on this market for several months now. We were sitting here 67, 68 cents. Seems like we get 1 or 2 days up and then the market goes back down again. But what's really amazing, all of these moving averages this close together really tells us that we're kind of at an equilibrium type market, and the market doesn't have any feel for which way it wants to go. I would suggest that maybe it's a little bit of the calm before the storm. The market doesn't seem too excited, but we've got 3.3 million acres of cotton left to get planted in a lot of those areas that are very, very wet right now. So I think that there's potentially something here, a potential move to the upside. Maybe you go back and challenge the 200-day moving average. If you got to go way back in the chart, you go back in December, we were 72.7. That might not be a bad place to be putting some offers in up around that 72-cent level as well. I don't want to be a seller today. RSI and stochastics, probably towards the lower side, at least at 70.5 to 72 cents would be a good target for me. And it's above the insurance price. Again, another one of our goals. Soybeans. Kind of a sideways market, but it's been in a 50-cent trading range over the last month. We've just come off of a challenge of a recent low. You can see the stochastics down into the teens, 20s now here this morning, starting to turn back up a little bit. I'm not sure that we do have a bull story here. I see the fundamentals. They talk about Chinese prices being very weak right now, being a lot of meals sitting around in China at the moment. So maybe there's not a whole lot of a story here in beans other than the United States balance sheet. The United States balance sheet is pretty supportive to beans. We're looking at next year's carryout, maybe in the 2s to 300 million range, which is not a burdensome number. Now, will we pick up some bean acres? I think that's a legitimate question. Will we see some prevented plant of corn flip over into beans, especially in the Mid-South? Could happen. Not yet, but I think over the next couple, 3 weeks, that'll be something that gets talked about just a little bit because of where the unplanted corn and cotton acres are. Can some of those go to soybeans? So that would be the potential story that could be a little bit bearish. So that being said, you look at the insurance price at 1054, the recent high 1065 and a half, the February high 1075. It tells me in that 1055 to 1075 range probably be a place I'd want to have some offers in again to be making some sales. Finally, in corn. Corn's kind of been the weakest link as of late, and I think the trade has been focused on crop conditions, especially in the Western Belt, that things have improved quite a bit. The drought situation has improved quite a bit. Some of the forecasts out through June have improved quite a bit. So that has been the driver to the downside in the corn market. It's been kind of counter seasonal. We just haven't had that seasonal rally yet. Will we get it? That's the million-dollar question everybody's got right now. Here today, as I record this, the market did bump a little bit. We've pushed back up to the 9 and the 20-day moving average lines at 443. You can see we've got several above us yet to go. You've got the May high at 456 and a half, then another dime or so up to the April high, another dime to the February high, the insurance price at 470. I think once in the last 14 years, we failed to go back and trade up over the insurance price. And well, we didn't quite get to it in April. So can that happen? I still think the market is not paying much attention to the unplanted acres yet. Especially Southern Illinois, Southern Indiana, Ohio, Pennsylvania, Kentucky, Tennessee, that region. Normally at this time of the year when we have unplanted acres, it's in the upper Midwest. It's North Dakota, South Dakota, the later planted acres, the later season. That's not the case this year. So this is what's going to be really interesting to see what happens with these acres in the Mid-South and the Ohio Valley. So can that give us a rally? If you look at the balance sheets and if you look at my ending stocks matrix that we had in the market report this week, you don't have to shave acres off very far. With the demand picture that we've got right now, you could really put corn in a fairly tight situation pretty quick. So I'm not a seller today. Again, the RSI and stochastics have just turned higher with yesterday's close, today's move. So I'm going to sit back and wait. Uh, I mentioned 2 weeks ago or so, we did a thinking cap on buying calls, courage calls. Not a bad time to do that right now, again, with the market starting to turn back higher. If you think you want to start making some sales up into this 470 area or so, but you're going to be nervous about doing it, buying the calls now is going to give you a little bit more courage to do that. So not a bad place to look at that. You could look at that strategy in beans. You could look at it in cotton right now as well. So with the market down towards a low, that'd be the time I'd want to buy those if I want to consider doing so. So with that, thank you for listening to this edition of the Thinking Cap. Hope you have a great rest of your week. We'll talk to you again very soon.